Good evening, ladies and gentlemen. Happy Saturday to you all. Hope you're having a wonderful start to your weekend. And we have a warning sign flashing on the market, and we're going to dive into how the week went, give you kind of the news and some of the things that we're seeing before we dive into the biggest winners and losers and key levels for the market for next week. So if we recap the S&P 500, basically a sideways down week. We had some price action going up and down, but most of the week was basically a pop to the upside, sell off, and then head lower afterwards. Every single day closed below except Thursday of the previous candle's low, and we pretty much had a hammerish style candle on Friday where the bulls tried to defend the level, tried to reclaim it, but then the bears shoved them back down. So it's nice to see some price action finally show up. Volume was actually interesting, where a lot of buying and selling volume, everyone's trying to buy the dip, and that really continues throughout the market. You see that you have previous volume basically dropping off as you're going lower, ramping in volume. So the question is this a warning sign that we could get a reversal, or is it a warning sign that we're about to head much, much lower? And we're going to be covering all that in the key levels of the market, but quickly just recapping the NASDAQ and then IWM or the Russell. NASDAQ actually the stronger of the two indexes, having an inside day on Friday and then an inside week for both indexes on the week. So basically means that you had a contraction after an expansion, which is normal for the market. You want to see consolidation, that's healthy, before the next move. Now, is that move going to be up or is that move going to be down? I don't know. We have to see. And the Russell basically just having a bloodbath week, closing below the previous week's high and low, almost like a morning star pattern here, maybe signifying where the rest of the market is going to go. The Russell has been a good indication of what is to come. But what drove the markets down this week? So diving into the recap, Monday was a closed day for a holiday, and then we had Bullard speaking on Tuesday along with Williams, both indicating kind of the same story, data dependent, nothing revolutionary. We had building permits and housing starts come in higher than expected, kind of showing that services or shelter cost inflation is probably not going to subside in the near future, unlike some of the Fed chairs do believe that they're supposed to see in the fall a subsiding of that pressure. But as of now, the housing market is still staying red hot. There's no cooling. Then Wednesday, we had the big man himself, Powell, coming out. And like we covered in the Russell video on Wednesday, link down in the description below for that if you guys want to watch it, is that usually Powell has a up day and a down. Obviously, Wednesday was the down day, Thursday was the up day, and then the market decided what it wanted to decide on Friday, which was try to kind of give you a sampling of both. So Powell just kind of talked about the same thing. It was almost like a mirror image, just driving the hawkishness in his FOMC speech to the House and the Senate, where higher for longer, more rate hikes. This is a skip. This is not a pause. We're not cutting rates anytime soon. And we cover that all in the Russell video. So if you guys want to watch more detail of that, I'm just giving you the too long didn't read version. But again, the Federal Reserve is not done hiking, and we're going to be talking a lot about that in the discussion section of the video. So timestamp down below if you guys wouldn't mind checking that out. And also, if you're enjoying the video so far or find any of this interesting, throw a like on the video. It really helps the YouTube algorithm, and maybe consider subscribing to the channel if you think this is helpful. And if you didn't think, or you kind of just want to see something different, throw it down in the comment section below of what you would like to see different. It really helps us tailor the channel to you guys. So without further ado, on Friday, we had initial jobless claims, and this is where it starts to get interesting, because I'm going to touch on this in the discussion. We're starting to see a tick up in jobless claims, and usually at 250 mark is where we start pivoting, where the economy starts degrading, and we're having continuous jobless claims. We have home sales again going higher, so higher demand, lower supply. They're not coming back into balance with one another, and could drive shelter cost higher. And then Friday, we just had services PMI again. Services sector staying very red hot in the market, manufacturing basically going in the toilet, and that usually shows signs of a weakening economy overall. But again, guys, the economy and the market are two different things, so just be careful about construing those two. One of the interesting things was that the net speculative positions basically came in back to the level that we were during basically most of 22. So you see they put on the big short, come back to like a level around the 200,000s, and net speculative, and then basically slam on shorts, get capitulated out, and now you basically, what I would say is the big players are only there. So it's the $1 trillion short that's currently on with a paper loss of $100 billion. If you thought your losses were bad, boy, $100 billion is nothing for these big cats, and they're basically not capitulating. So again, until we see them capitulate, I don't foresee a bull market existing, just because there will always be an emboldenment of short sellers to continue to try to short the market, and that big position really needs to basically capitulate to allow these big players, these big fish, these big banks to basically come in and buy the dip, or basically buy it up. If you trade in the 2017 market, you remember those 5-minute candles of an absolute insane percentage, 2% candle in 5 minutes. Absolutely insane. That's what big fish do. We don't have the little nib that we have now, where the market just basically just goes sideways up, but at very short increments. It was just a pound the pavement move. So looking at everything, we're going to dive into the biggest winners and losers, and then we're going to go into the key levels for the market. And I got a couple interesting things. I'm actually going to incorporate the Russell in the key levels now. So if you guys want to skip to any part of the video, all of it will be timestamped down below. But Fadel's going to give you the biggest winners and losers.
So this is the first week after Powell announced that they are not going to have an interest rate hike in June. And I got to say, it's not looking too good. You guys can see here that on the 5-day, this thing fell 1.13%. On the 1-day, just on Friday alone, this thing fell 0.77%. So not exactly what you would expect after the Fed came out saying we're not going to raise interest rates this month. However, well, when they started talking to Congress, Powell said we may actually have 3 interest rates this month, so, or at least this year. So that's very, very interesting to say the least, and that's why the market fell this past week. When it came to the earnings for this past week, nothing really happened though. You got Steelcase on Wednesday, FedEx on Tuesday, Lazy Boy on Tuesday, but aside from that, guys, nothing really major this week, and we're not going to see it for a few more days. I would argue that maybe the beginning of July, that's when we're going to start seeing the big banks start to release earnings for Q2. But for now, these earnings are kind of lackluster. So let's jump now into the S&P 500 heat map to see what were the biggest losers and the biggest gainers. And you can see here that, well, I mean, it did fall overall a significant amount this week. Not surprising that this is just a Ruby this week. And looking into the technology sector, everything here is essentially in the red, all except for, I believe, 2 companies, guys. The best performer would actually be the company Tyler Technologies, from what it's looking like. Yeah, it is, gaining only 0.59%, and Apple gained 0.36. The worst performers, you can see, there's a lot of them here, guys. There really is. And by far was none other than, by the looks of it, well, the chip manufacturers, AMD, and just all the chip manufacturers in general, guys. Again, the idea that chips and just tech companies are going to skyrocket as of AI develops, right? That is just ridiculous to me. In fact, we're going to show you an article when we get into the debate part of the video that I guess foreshadows a lot of what we're going to see. Nonetheless, though, AMD was the worst performer when it came to this sector. And actually, no, I am so terribly sorry for that. It wasn't AMD. It was none other than Solar Edge Technologies, losing 12.2%. When it comes into the communications, we can see here a lot of red too. Best performer was none other than Take-Two Interactive, gaining 3.4, and Meta gained 2.45, and T-Mobile only gained 0.03, essentially flat. Worst performer, though, by the looks of it, would be none other than Warner Bros. Media, losing 10.21%. In the consumer cyclicals, very, very red once again. Best performer, it is none other than the company CarMax, getting 6.63%. And the worst performer, it is none other than, by the looks of it, guys, the company Etsy, losing 7.34%. When it comes into now the consumer defensives, kind of mixed. This actually didn't perform too bad overall. Yeah, sure, you have a lot of red, but you can see here that most of the red isn't that deep in the red. Overall, though, best performer would be the company Dollar General, getting 4.56%, and the worst performer, actually, Yeah, Newell Brands losing 8.08. But also, guys, take a look at Target. Target falling 4.36%. The banks are not out of the water yet, especially those regional banks. You can see right here, this whole entire industry is in the red. And this one's FRC, which is NA. It got delisted. Obviously, they went bankrupt. Nonetheless, though, the best performer when it came to this, there weren't even that many greens in this whole entire thing. Best performer would be the Progressive Corporation, gaining 3.44%. Worst performer, though, by the looks of it, would be the company Citizens Financial Group, losing 8.02%. And by the way, guys, when it comes to these regional banks, you guys need to keep an eye on this. And by the way, we will too, especially when they start releasing earnings, because, well, overall, guys, this is going to be a bloodbath, especially when it comes to Pac West, right? If Pac West comes out the same way that FRC came out after they had their earnings, where they say, oh yeah, like the people taking out their money, the outflows have slowed down, right? We might get another banking collapse in the form of Pac West. Just keep that in mind. We will cover that when they do have earnings, though. Into the healthcare sector, very, very green overall. Don't get me wrong, a little spots of red here and there, but overall, by far the greenest sector we have seen. Best performer from what it's looking like would be the company, well, it's actually Merck, gaining 4.75%. And the worst performer would be the company Moderna, losing 8.83%. The industrials did not fare any good at all, guys. You guys can see right here that, well, very, very red overall. Best performer is the company Generac, gaining 5.77%, guys. Look at that. Current share price of $129.07. This is a company that was sub 100 just a few months ago, if I'm not mistaken. So, yeah, this is a company that also fell from like 400 down to sub 100. So, just keep that in mind. Now, the worst performer by the looks of it would be none other than the company Boeing. Boeing losing 6.38%. The real estate sector, wow, that is just a ruby of a sector over here. Best performer, there's only one that gained. Company CoStar Group, gaining 3.2%. Worst performer, guys, this is going to be very difficult to find. By the looks of it, it's seeming to be the company Alexandria Real Estate Equities, losing almost 10%. That's absolutely crazy. And also, take a look at this, guys. Realty income fell sub 60. So, you know my rule when it comes to realty income. If this thing falls sub 60, I'm buying. So, I did buy. In fact, we're going to cover this on the monthly dividend update. I finally reached 100 shares of realty income, so that's awesome. So be ready for a lot of dividends when it comes to that one in the future. Actually, by next month, because I did buy before their ex-dividend date, so I will get that dividend. And on top of that, guys, now with 100 shares, I can finally start selling covered calls when it comes to realty income. The utility sector fell massively. There's only one green one, and that is the company Energy, only gaining 0.93%. Okay, so 1%. It's not too bad. Overall, though, very, very red sector. Worst performer was the company Entergy Corporation, losing 5%. The energy sector was a bloodbath too. Guys, energy has been falling a lot. Look at Chevron. Chevron is down to $151. Guys, I'm even considering buying Chevron for my wife next time I get her $25 into the account, because Chevron, according to my discounted free cash flow, Chevron should be worth a lot higher than this. So I might actually end up buying Chevron for my wife, depending on what it is by the time that money comes into her account. Nonetheless, though, best performer here would be the company EQT, gaining 0.59%. And the worst performer, it's would actually be the company PSX, Phillips 66, losing 6.35%. But also take a look at this, guys. APA 6.03. You got Oki losing 5.6, Halliburton 5.56. Like, it's just all over the place. Very, very, very red sector. And lastly, when it comes into the basic materials, by the way, guys, we covered this week the Mosaic company. So if you guys want to check out a discounted free cash flow approach on this company, which I know we've seen here a while, make sure to check it out. So if you guys just put MOS on the channel search bar, you guys could find this company. All in all, though, when it came to the sector, best performer, well, there's only 4 companies that gained. So let's go over these. We got CF Industries gaining 0.69%. What is this? NUE, Nucor Corporation, gaining 1.73%. VMC, Vulcan Material Company, gaining 2.63, and MLM, Martin Marietta Materials, gaining 3.01, which that was the best performer. Worst performer, by the looks of it, would be none other than the company CE, losing 6.28%. All in all, very, very red sector, and this is not what I was expecting. I was thinking that when Powell said we're going to skip, that the market was going to rally 10%. Man, was I wrong. This is exactly why you really can't predict the markets at all, guys. You really, really can't. So this is very, very interesting to say the least. And we'll see what happens, especially when earnings season comes. Because, you know, I don't think majority of these companies, NVIDIA, I'm talking about you, should be worth that kind of market capitalization just because they mentioned AI like 86 times in the earnings report. But we'll see. That pretty much does it for this segment, guys. Take it away, Mike.
All right, so diving into the key levels of the market, we're actually going to keep the same levels that we had last week's video, but we're going to add importance to this week's range. So again, to recap, the S&P 500's range for last week was 443.61 as the top, and then 428.58 as the bottom. That's going to give you your bullish, bearish breakout trade ranges. But really, once you're above these lines is where you get the importance, which is going to be the level for the upside potential is definitely going to be 438.37. And then the low side, which we're very close to breaking, is 432.47. So if we open up and basically just slamming down, I wouldn't trust the gap down, guys. That's the one warning. If you gap down Monday, I'm looking for the upside potential until we break the 428 level or the 430, just because it's going to be a psychological barrier. But looking at the volume, this is where I'm saying, and I covered this in the Russell video, that I don't know if this is a trap one way or another. So it's a warning sign for boat camps, because again, like I said in the Russell video, boat camps are seeing something they want. They're seeing the inside move, where they're seeing the downslide for the bears, they're seeing they're not breaking the weekly low for the bulls, but the volume is absolutely abysmal. This week's volume was almost like abysmal compared to the previous historic volumes, on top of it being a Jerome Powell week, on top of having data. It's just like, where'd everyone go? Now, the summer's supposed to be boring in the market, where you see a dying down of volume, so these bigger players basically go and come back in Labor Day. But again, it wasn't a very good volume day. So we really have to see how it all plays out. And the week, again, with the NASDAQ, similar story, the volume being red on the week, but just not really what I want to see. I want to see that ramp in volume. Now, we could be getting a reversal here just because it is an inside day. And for the NASDAQ, you're basically going to levels of the previous week of 372.85 for the breakout to the top, 355.20 for a breakout to the bottom or sell side, and the important levels are going to be 360 and 368 roughly. That's what you're going to be looking at for the break, and you are in a weekly price action zone, so it gives me more potential for tech to sell off. The MACD is maybe starting to get some rolling effect on it here, and Smart Money Indicator has basically told me that we should sell this rip all the way up here. So are we basically getting a weakness? Now, again, with tech, we do have this impulse here that usually when these impulses calm down, they basically lead to more downside potential. But then again, it has to calm down. It could go higher. So the S&P and the NASDAQ both having inside weeks. That means that you're due for either more consolidation next week or an expansion out of this territory. And basically, once we break these upper ranges, that's pretty much going to tell us which way we're going to be going. Now, again, with S&P, if we break the lower range, there is a bunch of gap, or at least the 422 gap, that I'd be looking to at least come down to. And really, you do have this convergence of this previous trend line right here that we broke out above, and we could easily come back and retest around the 428 area and bounce off. So again, we just have to be cautious about that this previous trend line that we broke back of, and when we come back to retest it, we could find a bounce there. Again, is just a trend line that you have to keep in the back of mind. I wouldn't necessarily trade off of it completely, but it could be interesting. On the daily, we do have a cross of the MACD on the S&P and a bearish style candle on the daily on Friday. So we could see more movement to the downside. This would be an interesting retracement if we consider this to be a 50% move on the market. Now we're looking at basically the 422 area, which would be right below this gap fill to come down, or at least the 38% retracement, which means we still have more potential to come down, bounce off this weekly range here, and basically go higher. Now, if this is a move to the upside or one massive A to B pattern, we look at A to B, B to C, C to D projects up to the 467 level, which would bring us back up above all-time highs, or basically right to all-time highs on the S&P 500. So again, this could be a bullish move, but it could also be a bearish move. Right now, it is looking like a more bearish move, especially on the weekly charts. But again, would you necessarily sell an inside candle day or week? Basically, not really. So I don't see the conviction from the bears that I'm wanting to, and I do see the conviction from the bulls, but it's almost calming down now. So we just have to be cautious about which way we play it. Again, with the NASDAQ, similar story. We do have inside week. We basically have a bearish cross of the MACD, impulse on the daily. So we have to see how it goes. Now, you did have an inside candle from the previous candle on the NASDAQ, so tech was still showing strength, especially because Apple had a basically straight move, green day, created new all-time highs, but didn't manage to hold it, so on a closing basis. But Apple is showing some weakness up here. So again, if Apple starts pulling down and basically breaking this trend line that it's held for such a long period of time, are we heading for a trendline basic break, or are we going to have a nice retracement of this move? Which, if you assume this is one big move and have a 50% retracement because Apple trades like the S&P, that will bring Apple to the 165 mark, which would pretty much take a nice haircut to the S&P 500 and the NASDAQ. So we have to be on the lookout for that. But if we look on the weekly on Apple, it's just a straight line move up. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 weeks of higher highs. So again, maybe a pullback is in order, but the MACD is not relenting. We are getting that sell signal. RSI is super overbought. So again, it is showing extreme strength, but is it going to show that extreme strength for a long period of time? So we have to keep an eye on that. Now, I did cover this during the week, and we're going to start covering this on the weekend deep dive, is the Russell. The Russell had an abysmal week. It basically closed below the previous week's low, and the high, it just crap the bed. Now the MACD is showing weakness on the Russell right here. Now they are separated from one another, so take that with a grain of salt, but it is a significant pullback in the Russell. So is this a pullback, or is this basically a move to the downside that's going to continue? We are nearing that 50% retracement on the Russell. So again, we could have some more downside in the market on the beginning of the week, but then have a more bullish week after that. So for the Russell, your levels, or IWM, is going to be to break the range of the previous week, which in this case is going to be the 180 mark to the 185.91 mark for the Russell. Once you get above the 185 or 186 rounding off, you are going to have a bullish week. You'll be above the previous high and could see continuation and setting up a possible A to B pattern on the way up. So again, we have to be cautious. I would keep an eye on the Russell, but really there's other warning signs out there like the VIX, dollar, and yields, which we're going to dive into now, giving you kind of the perception of how much fear is in the market and what is the dollar doing along with yields, because again, that market is way bigger than the stock market and we need to pay attention to it. So diving over to the VIX is still holding the trend line, and VIX being down at these levels is dangerous. It's because insurance is very cheap. I'm basically selling fire insurance on your burning house for very, very cheap. So people aren't really taking it, and that's a little concerning. So on the daily, we did have this trend line and we keep bouncing above it. We had an inside day on the VIX. We are starting to curl on the smart money, but the MACD is still cross bullish, even though we really haven't had a lot of bullish price action. So it is a divergence on the MACD. But VIX did close green on the day, and the week basically turned out to be a red week, but it did have gapped up on the week from the previous close, but closed below the previous week's close. So again, the MACD is still trying to pinch together on the VIX. It may be a couple weeks before we really get that massive rip up, but I do think if VIX goes sideways at this level, it would be an interesting area to maybe buy some insurance and pay attention to the market to see maybe if we get some more depreciation in the market as a whole. The dollar is showing relative strength around this area, but really just kind of going sideways in a very large consolidation period, forming basically a symmetrical wedge that it's going to need to break. So once you break the wedge to the upside or downside, probably coming into mid-July, you'll have a determination where the dollar is going and the market as well. But one of the things I notice on the daily for the dollar is the MACD cross, again, inverted from the S&P. The dollar is crossing. Smart money flow is saying, hey, this is an interesting point to buy in. So it had an inversion, inversion, and inversion again. So a strong buy signal here, pushing up to the upside. So the dollar could be bullish at this point, which would mean more downside pressure for the market. And finally, the biggest market of all, the bond market, kind of just showing basically more stagnation, where they really just don't know what Jerome Powell is thinking at this point. You see spikes up into the 5.5 for the 3-month, and basically just bonds are just kind of going sideways, like to no avail. So again, the inversion of the yield curve continues to be an absolute spectacular mess, and we're basically coming up to challenge the highs of the previous all-time high of the inversion at 1.092 or at 1.011. So not much of a percentage to invert more before we make a new high on this, which would be unprecedented in history. Usually when you create a high on the yield curve, you come back to retest it. So, and then 2 or 3 months down the road, you basically have everything collapse. So we have to see how high this can go. If it goes any higher, well, the market is probably going to have a nice rip your face off bear market crash, because bad things happen when this yield curve gets inverted. Not always, but again, it's really one of those, okay, first time of everything times 20. I don't sign up to that methodology, but again, the market is not caring what I have to think or say. It's going to do whatever it wants, but all I can say is this is a boatload of warning signs that we need to pay attention to, especially with when VIX is this low. You have rip your face off spikes on VIX, especially when it goes sideways. You can see you have these massive volatility spikes. So just be cautious out there with that. And let's see what news catalysts we could have for next week to drive us higher, to drive us lower, and see what the market has in store for us. So going into Sunday, we have Williams speaking, so that's going to be interesting to see what he says. But again, Williams and Powell have been kind of giving this muted version of not really commenting on monetary policy, and they're just basically now the Fed's pivoting to this whole week to month basis of a meeting and not really giving you any sum and substance in their speeches that they have throughout. And then Tuesday, we have building permits coming in. So that's going to be another thing to key event to understand, is shelter inflation going up, going down? We have consumer confidence for July. So that's expected to come in higher than the previous. So consumers are still basically spending money. So we have to see if we get a tick down in that. And then Wednesday, we really just have Powell speaking again on Wednesday. So what is he going to say that's going to be different than last week? Or is this going to be one of those things that Powell just comes out and talks about everything every single week? Or is it going to be one of those events that he's not going to comment on monetary policy? We've seen that before, where he'll deliver comments on monetary policy and then basically kind of say, hey, I'm not commenting on the next one. I'm just doing the other stuff that I want to do. So again, keep an eye on that. And then Thursday, he speaks again. So this most likely will be a non-monetary policy commentation, because Powell coming out and talking about monetary policy that much, I think he's a little sick and tired of that. He's just kind of going to panel events and everyone's just hyper focused on it. But on Thursday, we get GDP quarter over quarter, expected growth of 1.4%, so an uptick from the last preliminary print. But then again, if this comes in sub 1%, this is going to be carnage like no tomorrow, because that means the next quarter you're flirting with basically negative GDP growth. Or if this comes in basically very close to zero, we definitely could see a contraction of that. Now, remember, this is for Q1. We really didn't see any of the bank carnage around that time. You really didn't see the mass layoffs. You didn't see the tech layoffs. So I don't expect this number to be an absolute destruction, but it's showing a shrinkage or a below trend growth like Powell has said. So is that bullish or bearish from market? We're going to have to see how the market reacts to it, along with initial jobless claims. They haven't actually posted the expectations, but it's probably going to come in line with this, especially when you have initial jobless claims 4-week average basically ticking down a little bit. You may see some reprieve in that, and then pending home sales as well. We have Bostic speaking on Thursday, but that's pretty much going to be overshadowed by whatever Powell says if he decides to comment on monetary policy. And then the day after, we have the Fed's preferred metric of inflation. They don't have expectations yet, guys. So whenever this expectation comes out, we will make a video and we're updating on the weekly basis or the midweek update. We're going to come and cover that as well, kind of give you the game plan of how to trade this, and we're going to be covering especially the GDP numbers, so stay tuned for that. And most likely, let's say they wait to the last day, then you get the viewer requested ticker Friday that I will cover this in the beginning of the video, so make sure you stay tuned for that, or possibly consider subscribing so you don't miss out on it. So core PCE basically at 4.7. What is it going to come in now? Or is this going to be one of those you don't get the expectation because they really don't want you to know what's expected, that is going to go lower or higher for the market? And then again, net speculative positions as we always do. So it's going to be a jam-packed week. And now we're going to dive into the discussion part of the video where we're basically going to cover a wide variety of topics. I have a couple of things I want to cover, and then we'll see what Fatal wants to throw in as well. So first question for you, sir, is what do you think Powell's going to say on Wednesday?
I have no idea. Honestly, at this point, the market has no idea what the hell's going on right now. Like, this past week, we fell, yet we fell based on, oh no, we're going to get more rate hikes. But wait a minute, I thought that it didn't matter and that they were calling the Fed's bluff. But apparently now it does? Yeah.
Well, it's the famous phrase of keep fighting the Fed and then the Fed wins.
Right.
Never in history has the market won, but like I said, I think Powell's going to basically come out and, like, you know, when he goes to like major speaking events, similarly to last time where he testified before Congress and then he was on the panel interview and we were watching, like, waiting for him to say something, and it's like he didn't comment on monetary policy at all.
And nothing happened at all. And then the market was just like,
like,
okay,
scratching their heads, like,
I remember that. It was like a special thing, right? It was just like,
and now we get twice. Yeah. We get Powell on Thursday and Powell on Wednesday.
So what is PCE though?
So they actually don't have the expectations posted, which I find peculiar.
No. I get that, but when is it? Is it
Friday?
So the last day too?
Yep.
Oh man.
What's your expectations for GDP? Because that comes in Thursday and it's the quarter-over-quarter number. Last quarter was 2.6. They're expecting 1.4 now.
That's a massive decrease.
Yeah.
That's a lot. That's a massive decrease.
Now, the question for you is, and again, this is Q1, so this not where we saw as much of the carnage yet. So this was just when the carnage was starting.
Oh, okay, we're going to get Q1 numbers.
Yep, remember, GDP is always 1 quarter behind.
Oh, I know. Yeah. So, no, Q1 is when we saw the SVB collapse first. It was in March.
Correct, but I'm talking about like when you started seeing maybe like the cooling of the jobs market. You're seeing like the ISM manufacturing basically cooling off April, May, where
I think you might get a beat. You might get a beat or like a close beat, maybe like a 1.6.
So you're thinking 1.4, 1.6, like 1.2 range.
Not 1.2. I would say between 1.4 and the 2.6.
Okay, so you're thinking you're thinking more upbeat.
I'm thinking it'll be better than expectations, but less than the previous.
Okay, I think 1.4 or 1.3. I think they're going to come in right at expectations. I don't think they get above 1.4, just because you are seeing some of the in that quarter we're starting to get into the Fed's higher tightening, especially. That's when they started tightening, so you're seeing the damage already, and it's the perception of that damage that actually cools the economy. So the other thing is, like, you sent me this article that I want to cover real quick. Artificial intelligence is a 1995 moment for tech that could push stocks even higher. And
I love it because it's 1995, and if you take a look, bring up the S&P 500 in 1995.
So we go back. I'm going to go to the weekly view because this is going to be atrocious. Trying to get it to... If we go back to 1995. Right. Oh, wow. That's when that's...
it had a meteoric rise,
95. Okay, so here's the start of 95.
Where?
Right here. We start 95 right here.
There's the start of 95. Look at that run up. Look at that run up.
Oh, it was the
Look at
famous
that
dot-com
run-up
bubble.
right there. And look at that dot-com bubble right there.
And then it came crashing
And then
back
it
down.
came crashing down. Right. So the fact that I just pulled out that article, like I just saw it on Seeking Alpha, saying that AI is the new 1985, it's just like, I don't think you people realize what you're saying here. Yeah, stocks can go higher, and by all means, they absolutely can. But remember, it's not, how can I say this? It's what you pay for, right? At the end of the day, people look at stocks as ticker symbols. The problem with that is that there's a balance sheet behind that. There's an income statement behind that. There's a cash flow statement behind that. And every investment is the present value of all future cash flow, right?
Yeah, and the thing is, like, let's just go back to my favorite graph, right? 95, what happened? If we go back to 95 for the yield curve, if I find it. So, you know, in 95, you were heading up into higher rates, right? So you came out of the 93s, 94s going into it. You stayed pretty stagnant, but then when the dot-com bubble popped in 2000, you had a collapse in the yield curve inversion. Same with 08. And I'm like, now we're like, hold my beer. We went to new all-time highs. Let's try even higher.
So, okay, yeah, but that's mainly looking at graphs. Looking at the fundamentals, though, do you know what I mean by every investment is the present value of all future cash flow?
That basically you can overpay for growth.
Yes, but for example, how much are you willing to pay? Okay, if I were to tell you, hey, I'm willing to give you $1 right now for the rest of your life once a year, how much are you willing to pay for that $1? That's what that means.
Okay.
Like, are you willing to pay 50 cents for it? Right? At that point, you would say, yeah, of course I'm willing to pay 50 cents.
Are you willing to pay $2 for it?
Are you willing to pay $2? Well, at that point, it would take you 2 years to break even, right?
Yeah.
And so on and so on and so on. It's the exact same concept. Companies have cash flow statements, right?
Yep.
And that future free cash flow, right? The current value of those companies, is that future free cash flow worth the current valuation?
Well,
that's what that means. Do you get me?
Yeah.
Is that future cash flow, which is why I use discounted free cash flow, because I project free cash flow into the future, discounted back to today, and then I see, okay, is the price that the company's at right now worth that future free cash flow that I am projecting in the future, right? Obviously, that can be wrong based on assumptions, but regardless, it gives you an overall measure as to what the company should be valued. So I look at this and I'm just like, 1985 moment for tech companies because of AI. All I hear is just like, okay, you guys are gonna overvalue this to no end. Free cash flow's going to reap its ugly head, and when you realize, oh, wait a minute, these companies aren't worth this much, boom, you're gonna get the AI bubble.
You mean this bubble?
Where?
This NVIDIA bubble?
No, sorry, the pop of the AI bubble. But yes, the NVIDIA nonsense gaining 30%, 30 freaking percent overnight. Not even during trading day.
They're up 37% from the to current share price from earnings, and then
that's
43%. Now,
A
NVIDIA
market cap of $1 trillion. That to me is just
well, you want to see something ridiculous? Up nearly what 270% in less than a year.
What's the year to date? But yeah, so what's the year to date on NVIDIA?
It'd probably be lower, probably 180. So if I go back to June of there to
No, not June. No. That's on the 1 year. Year to date is January to today.
Oh, okay. That's
so year to date is 195%. It's 195% right now on NVIDIA. On the 1 year, so that's looking at June 24th to June 24th, that's 160.
Can someone say bubble?
I mean, just on the year to date, dude. If I were to tell it, could you imagine NVIDIA? Okay, NVIDIA, this just became a rant on just NVIDIA, January 3rd this year, 143. Bro.
Well,
imagine, bro.
You can here's the thing. It's like, regardless if we value it at this or not, why are the biggest shareholders, CEOs, vice presidents, board members that have been with NVIDIA for over 3 decades selling stock?
Well, I don't necessarily know, right? Because people have their own reasons. But what I'm more interested in talking about is this net speculative position that you told me about the other day.
So they actually, which was interesting, relented a little bit. And if you look at the speculative positions like I covered, you come into June, you have the big basic coming down, big short, right? They go big short, they kind of capitulate, sit around the 150, 200.
They stagnate, and then they
Then put on the really big short. And this is where everyone just got short happy, and then they got basically blown right back to where they started. Right. So we're back. We went in a circle. But the original $1 trillion short, which is sitting in here, is still there. They have a paper loss of $100 billion. And they're just basically sitting there being like, okay, whatever. So
that's going to be interesting. Because if the market does keep... Oh, and by the way, the market as of this week went down, right? But if the market does keep trending higher, these people are going to be out of hundreds of billions of dollars.
Well, here's the thing. I've noticed this.
What do they know?
It's not about what they know. It's like they know something, and that they're obviously looking at the deterioration of the economy, and they're basically like, when you get to that level, you just print money. You crap golden bricks for literally. So again, the thing is, like, if you see the disjointedness of the indexes, look at the Russell. The Russell basically forming this head and shoulders pattern, kind of coming into fruition now, and
I need to take a look at more on the Russell, because that's the one index I don't look at all.
So Russell's an interesting index because it's 2,000 stocks. It's small caps, right? So small caps are basically your foundation of the economy. Yes, the big stocks do the big move, but if your foundation goes, it's crap.
Right.
And
I mean, we have been seeing that only 8 companies
5
are holding up the whole entire stock market right now.
I would argue Apple's holding up the whole... That's why we didn't really get a big sell-off in the SPY and tech, is because Apple was actually green during most of the week.
I see.
But the thing is, looking at KRE, right? So we talked about KRE on the weekend, and I actually want to go to this graph real quick for KRE. And you're below the 50-day moving average. You actually nearly got rejected off of it, and you filled this gap. So, okay, this gap is checked, right? My thing about gaps. So
they always fill.
Yep. Yeah. So look, higher low, higher low, higher low question mark. So are we gonna now rip up on regional banks, or is this gonna be where the final dip buy fails? Because they've been trying to buy this dip, and it hasn't been like the famous phrase of buy the dip gets dipper. And regional banks are now below the support.
You mean the dip gets deeper?
Yeah, dipper.
Dipper, okay.
Yeah. Sure. But regardless, you had the inverted head and shoulders that was basically forming here, kind of failed. So now that pattern's busted. You are heading towards this low here, which it's going to be a critical tipping point. Get below 38, and carnage may be ensuing. Again, doji style candle could show basically a 50% of the move, or a reversion of the meme. So if you get another 50% move, probably take you down to this 35 level. And all it takes is one regional bank reporting bad earnings. And what do we know? We're coming into earnings session soon. So you got a lot of grenades you got to pull the pins on and hope they don't blow up in your face.
No, yeah, I definitely agree. And the earnings is going to be crazy. Because remember, we're not going to Q3, meaning we're going to see Q2 numbers. And we are definitely going to cover overall, guys, especially NVIDIA. That's one. NVIDIA, Budweiser, of course, the big tech giants as well. So that'll be fun.
And you see, PacWest earnings is actually July 18th. So we're nearly 3 weeks away from having the regional bank that nearly started the next leg tell you. I
remember that.
It's gonna remember what they said last earnings. They said we're looking at strategic options.
No. That and remember what was the other one that fell off? First Republic, right? First Republic, when SVB was collapsing, they were falling, but they didn't collapse all the way through. Then when they had earnings and they said, "Oh, we're getting a bunch of people, leaving us," that's when they collapsed. So we might get the exact same scenario when it comes to PacWest.
And not even that. That's the proverbial one bullet in the chamber. You have Western
Right.
Alliance, same story. All these banks have been selling their portfolios, and here's the thing. If you sell your portfolio, you're taking cash in. If you take cash in, that means that, okay, you're not getting that cash flow from that portfolio anymore. So it's good and bad, right? But if you have realized losses later down the road from something else, yeah, it's going to be pretty brutal. So especially with PacWest is going to be one of those you're going to keep an eye on, because look, you don't really have much of a way to sub $1. Like a 23% drop, similar to what FRC did.
Actual penny stock.
Yeah, like, you know, if you come down here, if like you get a 50% day, you're back down towards these lows. And earnings can do that, right? This is a high volatility stock. Earnings can do that. Yep. So you had a bank that said, for all those that don't know what we're looking at strategic options basically means, is we're looking for someone to buy us out because we're basically going to go BK if we don't. And that's not something you want to hear from a bank, especially what caused FRC to basically fall off a cliff, because they said that, plus the deposit outflows.
The exact same thing.
So again, you have no longer do you have like one. And here's the thing: FRC, no one was necessarily looking at it at the scrutiny that these banks will be under, because FRC, we knew they were in trouble, but they didn't really. No one was like, it wasn't mainstream news, right? It wasn't like banks. It wasn't like you didn't hear about FRC until like the whole thing unraveled. Now you have a literal hit list, as I call it, of every regional bank. One of them reports carnage, or if you get more banks saying we're looking at strategic options, it could easily unravel the entire banking sector. And the whole banking sector goes, the whole market goes with it. And here's the thing. I don't care how much Nvidia and Apple hold up. If 2,000 companies go bust because they just get a carnage selling, right? Let's say you take this down to the furthest extent you can, right? If you get mass carnage in the Russell, and then the Magnificent 5 or Magnificent 7, whatever you want to call it, basically just kind of just stay where they are. The market's not 5 companies. It's 500 companies. The Russell's 2,000. So again, you can't survive with 5 companies.
Right. So that's going to be interesting. But yeah, man, I think that's where we're going to pretty much just end it right here. If you like, comment, subscribe. It really does help her with the algorithm on YouTube. Y'all can follow us on the New Tech Sites. Link is in the description below. So with that said, peace out, and we'll see you all next time.